Hello, everybody, and welcome to the Like a Tortoise channel. I'm recording this on February 26th, and it's another exciting day in the markets. I can see the Nasdaq is already down. What is it? 2%? 2.03%. My goodness, how I love this! It's amazing, isn't it? Unless you are trading with leverage and you don't have a long-term framework, then you are obviously panicking. But this is fantastic for long-term investors, the tortoise breed. All right. So some of you asked me to analyze Amazon, and that is the core of today's video. I want to delve deeper into Amazon's fundamentals, whether I think the company is a good investment at current levels, and whether I think this is a company that will have a place in my own portfolio. All right. For those of you who are watching this channel for the first time, welcome. I know many of you have recently joined, so with the number of subscribers continues to go up, which means that we are putting more value for all of you. That makes my day every single day. Does that make sense? So if you do enjoy it, please smash the like button. It really helps the channel to grow. And I only use eToro for educational reasons, but I like to use in fact, I use interactive brokers for all transactions, right? So we have put out the Like a Tortoise portfolio about 2 years and a half ago. The portfolio is completely I share it. I share our positions here frequently, very transparently, so you guys can see exactly what I'm doing with that money. Full transparency, skin in the game. That's what matters. That's what we want, right? Okay, guys. So let's talk about Amazon. But before I do that, let me just bring your attention to our school community that we recently relaunched. And we did that for you, right, based on the feedback that we've collected over time. So up until now, I was only doing coaching, one-to-one coaching, which is very personalized, but I wanted to create a platform that actually allowed for more engagement between us. And many of us are like-minded people, and you asked me that, so I just decided to relaunch the school community yesterday. And this hasn't been that active up until 3 to 4 days ago. And yesterday I relaunched it. So it's completely free to join, and you will gain a ton of value. I mean, if you come here to the classroom, you can see there are many hours of work. This took me so long to actually do. It took me a lot of work, but I think there is a wealth of knowledge right here in every one of these modules that you guys can benefit and that you guys can benefit from. Okay, so from fundamental analysis, technical analysis, my background and framework, introduction to investment basics, adds personal stock of the month, which is something that I want to start doing on a monthly basis. It's completely free to join, right? So that will you can join for free. You won't pay anything. It's standard. That it falls into the standard package. But then, of course, to unlock many of the modules, you're going to have different tiers. Can be premium or VIP. And the goal here is to provide as much value as I possibly can outside of YouTube and outside of my one-to-one coaching with current clients. All right. And if you have any questions about that, just let me know. But again, join. It's entirely free and just explore the platform. You will see start here, and then you will see everything that you need. How this community works is the first module, and so you can take your time around it. All right. Okay. Let's talk business. And what we want to discuss today is Amazon, right? So as you can see, this is a company that has been on my watch list for a while. I think it's a great business. The only question is, are we paying a decent price relative to the company's fundamentals today? This stock, if I go right here, Baba is getting smoked today, almost down 4%. And look at tech. Yeah, big tech is getting hit today. We can see already more rotation out of big tech names right into more defensives, even though some other tech companies are also, look, software businesses are taking a breather. This is probably on the back of CRM's yesterday's results, which were better than expected, and they actually provided a good guidance as well. But and so they are taking a breather. I mean, it makes sense because this sector has been completely wrecked. PayPal is also down, but I mean, that doesn't really surprise us, does it? Okay, so let's go here to Amazon. Where is Amazon? Oh my God, right here. All right. Amazon, this stock is down. What is this? This stock is only down 20%, and you already excited about that? Really? You should be excited when this stock was down almost 60%. Look at that. This was in 2022. Well, at the end of 2022, right here, January 2023, this stock was down 57%. That was, in all likelihood, the price you were paying a very good price relative to the company's valuation at the time. Okay, look what happened after. These are the type of opportunities that we love to take, because I mean, seriously, with the stock only down 20%. Now, granted, only because it's 20% down, that doesn't tell me anything about the fundamentals, right? It can be down 20% and it still be very expensive. So let's discuss that right now. Okay. Okay, let me just minimize this. Cool. If you didn't know already, right, in the case you are watching this for the first time, I have a free, so I don't pay for stock analysis. Whenever I'm doing stock analysis research, I only use stock analysis platforms. That is Stock Analysis and Stock Unlock. I only subscribe, so I only pay for one of them, and that is Stock Unlock. I pay about $9 per month, because I like to see 10, 15 years worth of data. That is important. I want to see consistency and predictability in the numbers on most occasions. Okay, and I like to see that. So unless you really upgrade your account, you won't be able to find that. And sure enough, that's why, for example, here on stock analysis, if I come here to revenue of Amazon, it only goes back to 2021. All right. Anyway, okay, so let's start right here with Stock Unlock. And right off the bat, let's go here to Amazon. Here we are. And you can see that Amazon has a 4.07 score out of 5, which is very good. So based on the criteria, if you go to the score tab, you can see that they score high on profitability, management, growth, financial health, also valuation right now, according to by their standards, and also analysts who seem to be always constructive on this company, and rightly so. It's a great business. Right. And now let's judge the company through our look like a tortoise lens. On the income statement, the first thing that I like to pay attention to is revenue. And since 2017, the revenues have been exploding, as you can see, compounding at almost 20%. I was talking to a client about this the other day, and I even mentioned that in one of our episodes here on YouTube. It's incredible how much these companies have grown. Even now, they are already behemoths, right? They are everywhere, and they are still managing to grow at double digits, and that is incredible, absolutely incredible. Okay, 2017, about 20% per year. Very good. What about operating income? 47.47%. But you can see how much that exploded since the lows here in 2023. And this was when the company was down. Was it around this time? Yes, it was. When the company was down about almost 60% from its all-time highs. All right. And then since then, look at that, going absolutely bananas. And the earnings, right, doing the same thing. Look at that, exploding right here since 2023. So it makes sense for the price to be also going up, right, in conjunction. They don't do, if you go to the diluted shares, they've compounded by about 54.18%. It's quite volatile as well. But yeah, so right off the bat, things seem to be pretty cool. From like on the financial statement, nothing really concerning right here. If I go to the metrics, let's go to the gross margins, and you can see how nice this has been going up. And this is a sign of pricing power, ladies and gentlemen. Since 2027, the margins have been going up. It's a sign of pricing power. It's a sign of them selling more of their stuff as well. And that, of course, bodes very well for the company. Look at the operating margin, right? Since that trough here in 2023, it's been going up as well, right? And well above average, which is good. And same thing with net margin as well, okay? So we like to see that. Nothing bad about it. In terms of total assets, if I go right here on a yearly chart, you can see how consistently this has been growing. And this is what I really like to see. In the perfect world, we would see companies growing revenues, very consistent earnings and revenues, and all of that. All that really matters, like this, right? Very consistently, and that creates a lot of predictability. And this is what we want as long-term investors. Total cash probably down. Oh, it's actually up, right? Look at that. It's quite. It's quite. This is interesting because they tend to invest a lot, as you know, but they most often use free cash flows, even though sometimes they actually use some of they make the investments off their balance sheet. But they produce a very strong free cash flow, so that won't be a problem for them. Liabilities, you can see it right here, also growing at about 22%. But I can see that we can see that total assets have been growing faster than total liabilities. And sure enough, the book value is compounding by about 14.48%. Look, guys, I love that. And look at the retained earnings of the company, right? The accumulated net earnings, which is absolutely staggering. If I go here to the cash flow statement, cash from operating activities exploding. Look, fund absolutely insane, compounding at 26.17% per year. Let's have a look at the stock-based compensation, very high as well. But the question here is it high relative to revenues and operating cash flows? That's what we have to determine. We will look into that very soon. Okay, it's coming down though, which is good. Let's have a look at the cash from investing activities, exploding as well due to capex investments. Amazon is one of the companies investing a ton in capex, right? Investments in plants, property, equipment. So data centers mostly in GPUs because they want to be at the forefront of AI innovation. And you can see how that has skyrocketed since here 2023, together with all the other companies in the space, like the big magnificent seven. We are seeing this across the space, with the exception of Apple. With the exception of Apple. Okay, free cash flow, I don't read too much into that. Again, Amazon sometimes has negative free cash flow. Look what happened in 2021, 2022, because they reinvest. They are famous for reinvesting everything back into the business. I love that, and this is exactly what you want, but not every company is in that position because not every company is in the same industry. But what I want is I want a company with plenty of reinvestment opportunities. And this is something that you will see on other quality channels. Many of them tell you about great a lot of reinvestment runway. And this is awesome because it means that the company is operating right in an attractive industry. So there is a lot of demand for the stuff that they are selling, and so they can continue to plow money back into the business and by so doing achieving returns on high returns on invested capital as they continue, right? As they continue those reinvestments, because ultimately you want that to be translated into more profits down the line. Okay, if I also go here to metrics, let me have a look at that, because we were discussing the share-based compensation as a percentage of operating cash flows. Right now, this is the trailing 12 months. Okay, let's flip this to the trailing 12 months time frame. And we can see that share-based compensation has been coming down massively since 2022. Is this a good thing? I think so. I like that. I like to see that Amazon has been bringing the share-based compensation down over time. because I mean, there are different ways they can reward their employees. One of them is cash payments, right? Cash incentives. And they can do a combination of both without doing a lot of share based compensation because that runs the risk of diluting existing shareholders unless they offset that with buybacks. Let's have a look at that. Are they doing any buybacks? Let's see that repayment. Mm, are they doing? What am I? This is cash. No, of course not. Yeah, I mean, I wasn't expecting them to do so. Not least because the stock is not even cheap. If you ask me, as we will discuss. I mean, look, I'm very conservative, but many people already believe that Amazon is attractively priced at current levels. I just don't think your margin of safety is big enough. But yeah, so they prefer to reinvest back into the business, and I completely understand that. All right. Also, if I come here to the stock analysis tool, right here, statistics, what do we have here? No, yes, statistics. I want to see that. Let's go back here and we can see that they do have, so they have a negative cash position, as you can see. They have about $123 billion worth, well, they have 123 billion of cash and cash equivalents, but they have about $178 billion worth of debt, which is a lot. Okay, that is a lot. So they have a 55 billion negative net cash position, which is the same as saying net debt position. All right, but they produce about 7 billion in free cash flow. So if we look at the financial position of the company, you can see that debt as relative to free cash flow is quite high, right? At 23 times. Ideally, I want to see this under 3, but this is not accurate because again, Amazon uses a lot of the free cash flow to reinvest back into the business. And so you would have to look at, for example, debt to EBITDA, which is definitely under 3. And if you want to be even more conservative, you can calculate the debt relative to net income, and that should be under 3 as well, which means that the company could cover all of its debt within 3 years of current earnings, right? That's what we want. Interest coverage, very bullish. So this is positive. It means they can cover all the interest payments on the debt with right. So the interest payments relative to how much they produce in operating income is quite conservative, which is something that we like, of course. And also, if we go and have a look at the margin, in fact, we already discussed that, haven't we? Yeah, we discussed that. What else do we need to talk about, guys? Let's have a look at what insiders are doing. You can see that insiders, look at this wave of selling. Let me have a look at here. Yes, so do you like that? Do you like to see that? Look at this. Look at this wave of selling right here. The CEO has been selling like there is no tomorrow, and I don't like that. If I go next, look at this, selling, more selling. Let's go next. Selling, 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 selling. Insiders are selling like crazy. Like crazy. I don't like to see that. But if we look at the ownership, you can see that Mr. Bezos still owns about 200 billion worth of stock, which is very bullish. The president and CEO currently owns about $472 million worth of stock. And so nothing, you have high insider ownership, which for sure, look at that, the insider ownership sits at 9%. So we are talking about an owner operator here, right? And we love that. We love that. We know that Jeff Bezos sits at the board, still has a say in what the company is doing, which we like that as well, because he's one of the best businessmen of all time. And what else do I want to say? I want to have a look at the returns on capital. In the last video, I talked about the returns on capital for Meta, and we discussed how and why they have been coming under pressure over the last few years, ever since they run up capex, right? Because of all the AI investments. And let's see if the same applies to Amazon. And I think that should be right. So if we go to ratios, return on equity, let's have a look at the return on invested capital. It's still high though, but you can see that it's now coming under pressure. But look at that. So, yes, so it's coming under pressure, but it's still high relative to where it was right here in 2023 when they really kick off that massive wave of investments, right? But the return on asset, but they are coming down. Now the question here is, let's zoom in and see the quarterly metrics. Okay, nothing really concerning, right? It's coming down, yeah, but nothing really concerning. So if you look at a company like Meta, then you can see a big hit to the company's returns, so capital allocation, and they are still very bullish. By the way, they are still strong, but it makes sense. And look at this. If you look at Royce, right, for a company like Amazon, this is important again, guys, and it comes back to understanding the business. So if I move to the annual chart so we can filter out the noise, you can see that Amazon's Royce hasn't always been very good, as you can see. And there is a reason for that. The company always purposefully, right, reinvest a lot into the business. And what that does is it depresses Royce. Even when those investments translate into higher profits, because they are always investing, that will really put downward pressure on Royce. But what happens is the returns, right? It's just like a snowball that continues to get bigger and bigger. And this allows the company to literally take over the world and worry about profitability at a later stage in their business cycle. And I completely understand that. And this has worked very well for them. They are masters of doing this. And so I don't think that is a major, like any cause for concern. And that's it, guys. Now, from a valuation standpoint, the best metric for a company like Amazon, if you ask me, is you have to have a look at look at the price to operating cash flow. In my opinion, that is the best metric. And so if I go here, right, let me go here. I'm on stock and lock. You're going to put here in Amazon. And then what you're going to do is you're going to have a look at the price to operating cash flow. I will show you exactly why I think this is the case. If you look at net income for Amazon, it looks like this. Okay? Now take a look at operating cash flows. Operating cash flows. You see what I mean? It's smoother. It seems to be a better metric when it comes to assessing the company's really like potential, right? Potential cash flows. And so I think this is the metric that you should be emphasizing. All right, which is of course because it has the operating cash flow still includes all of the capex that the company hasn't spent yet. Okay, so let's do the price to operating cash flows. And you can see that historically, price to operating cash flow, going back to 2014, look at this. The latest one is right now, the company's current price to free cash flow, price to operating cash flow sits at 15.97. You can see the low that was achieved, the lowest point that was achieved going back to 2014 was 15.76. So based on this metric, Amazon is very cheap, very, very cheap. Is it cheap from a like a tortoise standpoint? The answer is no, and I will show you why. I will show you why right now. Let's go here to our proprietary intrinsic valuation template. so you can see exactly what the numbers look like. So this is where I keep many of the companies on my watch list, and I run the intrinsic value on each and every one of them. And sure enough, if I show you Amazon, come on, where is Amazon? Right here. Here it is. Okay, so Amazon, you can see that we have the current price right here. Um, the current price of this company right now, Amazon is trading for about $205 a share. I already have the shares outstanding right here, which you can find on the income statement. The perpetuity growth rate, for those of you who don't know, is always 2.5 and 3%. What is that? It's the rate at which the cash flows, right, will continue to grow after year 10. So that is they will continue to grow right at into perpetuity. So we assume that they will grow at about the same rate that the economy does, and that's typically 2.53% in well-developed nations. So that's what I use. Desired return is always 15% because I want to double my money every 4 to 5 years, and so should you, certainly if you are a tortoise. And that's what we always use, 15% right here. The operating cash flow is the number that I have here. And what you guys will see is that based on the operating cash flow, the company is definitely cheap. And I showed you that right here on Stock and Lock, but that is also reflective on the DCF analysis. Because if we put, for example, the operating cash flow, say, what is the operating cash flow again of the company? We have right here, okay, 139. So if we put this number here, what you will see, of course, is the intrinsic value per share at about 239, with the stock currently trading at about $200 a share. Then, of course, you already have a margin of safety if you buy the company right now. So what is this tell you? What this is telling you is, if you believe that Amazon's operating cash flows can compound at 15% per year over the next 10 years, then this is the price you should pay. This is the price that you should pay for the company. With the stock currently at $205 a share, you have a margin of safety, right? Do I think Amazon can grow its operating free cash flows at least by 15% per year over the next 10 years? The answer is yes. And historically, as I showed you, they've done that. They've compounded operating cash flows at about 30%. So this is just about half, and I think it's possible considering the reinvestment opportunities that the company still has. That said, the company is larger now, so it's going to be difficult to achieve that. Okay, but anyway, so that's one thing, and this is the intrinsic value that you will get. Now, if you use net income, okay, then go back to our previous number. This is net income, and based on net income, the intrinsic value per share is around 133. So it's more conservative relative to the price it's more conservative, right? Because today you buy at 205. This is intrinsic value is based on net income. And based on that, then you should have to wait a bit longer, right? You should wait for the company to come back down to this number to attack. And sure enough, this makes a lot of sense when I run, for example, the other two rule number one valuation methods, which I have right here. So the margin of safety calculation method and the payback time method based on earnings. Look what they give me. So according to the most margin of safety calculation, the margin of safety entry price is around $110 a share. And based on the payback time using earnings, we get about $113 a share. This makes sense because in both models, we are using what? The earnings per share of the company. So it makes a lot of sense, and it coincides with what we have right here. So it's entirely up to you guys. I personally wouldn't buy Amazon at these levels. I understand why you would buy it. I don't think it's expensive, right? I just think, look, I think it's reasonably priced. All right, but I want to be conservative, and I want to make if I ever were to buy Amazon, And like I said, this company has been on my watch list for a while. I would wait for for the price to come down a bit more, so I would consider attacking. But that's just me. Okay. This is not financial advice, of course. This is everything we do on this channel is purely based, well, it's purely for educational purposes. That said, I put my money where my mouth is, and this is a company that has been on our watch list. Is a company that I would love owning at the right price. And today's is not the right price yet, not for me, not for the tortoise. Right, guys? This is it. If you like this video, please smash the like button. Again, it will really help the channel. Thank you so much for being dear viewers of our channel. Hopefully, we will continue to grow. And yeah, let me know what else you guys want me to analyze. Don't forget, so today is Thursday. On Saturday, we have our live group call at 10 a.m. London time, which is essentially the same as Lisbon time. And I'll see you there. Thank you so much, everybody.